Every single day, millions of people around the world open their phones or laptops and make a decision that could either build their financial future or erase months of savings in a matter of hours. And that decision is to trade the financial markets. Trading has become one of the most discussed, most misunderstood, and most pursued financial activities of the modern era, driven by social media success stories, the rise of commission-free platforms, and the democratization of access to markets that were once reserved exclusively for institutional investors and Wall Street professionals. But the uncomfortable truth that most beginners are never told up front is this. According to widely cited industry research and verified trading statistics, approximately 90% of novice traders lose 90% of their trading capital within the first 90 days, a devastating pattern so consistent that it has earned its own name in the trading community, known as the 90-90-90 rule. Furthermore, studies have shown that 80% of all-day traders quit entirely within the first 2 years of beginning their trading journey, and the traders who do survive and eventually become consistently profitable are almost universally those who treated the process of learning how to trade with the same seriousness and patience that one would apply to learning any other high-level professional skill. That is precisely why the very first step in starting your trading journey is not opening a brokerage account, not depositing money, and not buying your first stock. It is developing a complete and honest understanding of what trading actually is, what the different markets involve, and what the realistic expectations for a beginner genuinely look like. Trading, at its most fundamental definition, is the buying and selling of financial instruments with the goal of generating a profit from price movements, and those financial instruments span a remarkably wide range of markets, including stocks and equities traded on exchanges like the New York Stock Exchange and the NASDAQ, the foreign exchange market known as Forex, where currency pairs are traded and which handles approximately $6 trillion in daily transaction volume, making it the single most liquid financial market on Earth. The cryptocurrency market, where digital assets like Bitcoin and Ethereum trade 24 hours a day, 7 days a week. Commodities including gold, silver, oil, and agricultural products, and indices that track the performance of entire groups of stocks such as the S&P 500 or the Dow Jones Industrial Average. Each of these markets has its own unique characteristics: trading hours, volatility profiles, and minimum capital requirements, and a beginner's second step must be to choose one market to focus on rather than attempting to trade everything simultaneously, because spreading attention across multiple markets before mastering any single one is one of the fastest ways to become confused, overwhelmed, and financially damaged. For most absolute beginners, the stock market represents the most accessible and well-regulated starting point, offering the advantage of transparent company information, regulated exchanges, established brokers, and a wealth of educational resources, though some beginners are drawn to the Forex market for its round-the-clock availability and high liquidity, or to cryptocurrency for its accessibility with no minimum capital requirements and the ability to trade fractional amounts. Once you have chosen your market, the third step in the process is to decide what style of trading aligns with your personality, schedule, financial situation, and temperament, because not all trading is the same, and forcing yourself into a trading style that does not suit your nature will cause psychological stress that leads directly to poor decisions. The 5 primary styles of trading recognized by professionals are day trading, in which all positions are opened and closed within the same trading day so that no trades are held overnight; swing trading, in which positions are held for several days to several weeks to capture medium-term price movements; position trading, in which trades are held for weeks to months based on larger fundamental and technical trends; scalping, which involves making dozens or even hundreds of very short-term trades in a single day to profit from tiny price movements; and momentum trading, in which traders identify assets that are moving strongly in one direction and attempt to ride that momentum for profits. For most beginners, swing trading and position trading are widely recommended as the most forgiving starting styles because they do not require constant screen time, they allow more deliberate decision-making, and they are less susceptible to the rapid emotional swings that day trading and scalping demand a trained mind to manage successfully. The fourth step, and one of the most critical investments a beginner can make, is education, and specifically learning to read and interpret price charts using technical analysis alongside developing a basic understanding of fundamental analysis so that trading decisions are made on the basis of real data rather than speculation or emotion. Technical analysis is the study of past price movements on charts to identify patterns, trends, and levels of support and resistance that can be used to predict future price behavior. And the most essential tools a beginner must learn include candlestick charts, which visually display the opening price, closing price, high and low of an asset within any given time period. Support and resistance levels, which are price zones where buying or selling pressure has historically caused the price to pause or reverse, and technical indicators such as moving averages, the relative strength index, and the MACD, all of which help traders confirm trend directions and momentum. Fundamental analysis, on the other hand, involves evaluating the intrinsic value of an asset by examining the underlying economic and financial factors that drive its price. For stocks, this means studying a company's earnings reports, revenue growth, profit margins, debt levels, and competitive position in its industry, while for currencies in the Forex market, it means understanding interest rate decisions, inflation data, employment figures, and geopolitical developments. Most professional traders use a combination of both technical and fundamental analysis, but for short-term trading styles like day trading and swing trading, technical analysis tends to dominate because short-term price movements are driven more by market psychology and chart patterns than by fundamental value. The fifth step that every responsible beginner must take before committing a single dollar of real capital to the markets is paper trading, also known as simulated or demo trading, which is the practice of executing trades in a virtual environment using fake money so that you can learn how the market behaves, test your strategies, and develop your analytical skills without any financial risk whatsoever. Virtually every major trading platform, including Robinhood, TD Ameritrade's Thinkorswim platform, Interactive Brokers, and TradingView, offers a paper trading or demo account feature, and the importance of using this tool before moving to live trading cannot be overstated. Experienced traders consistently advise beginners to paper trade for a minimum of 3 to 6 months before touching real money, not just to practice executing trades, but to observe how their emotions respond to winning and losing, because the psychological experience of a trade, even a simulated one, reveals a great deal about how a trader is likely to behave under real conditions. The sixth step is choosing the right brokerage platform to open your live trading account, and in 2026, beginners have access to a range of excellent options that offer commission-free trading, user-friendly interfaces, and powerful research tools. Robinhood is widely recognized as the best platform for absolute beginners due to its commission-free trading, extremely simple mobile and desktop interface, and low barrier to entry with no minimum account balance requirement, making it the ideal starting point for those who simply want to begin with a small amount of capital and learn the mechanics of placing trades in a real environment. Fidelity and Charles Schwab are highly regarded for their depth of educational resources, research tools, and customer service, making them excellent choices for beginners who want more guidance and support as they learn. Webull offers a middle ground with more advanced charting tools than Robinhood while still maintaining an accessible interface for newer traders. When it comes to the actual capital needed to start, the answer depends entirely on which market you choose and what style of trading you intend to practice. You can technically open a stock trading account with as little as $100 on platforms like Robinhood, though most experts recommend having between $1,000 and $5,000 to give yourself enough flexibility to diversify, manage risk properly, and withstand the inevitable losing trades that every beginner will experience. An important regulatory rule to be aware of in the United States is the pattern day trader rule enforced by FINRA, which requires any trader who makes 4 or more day trades within a 5 business day period in a margin account to maintain a minimum account balance of $25,000, a rule that effectively means serious day trading in U.S. markets requires substantial starting capital. The seventh step, and arguably the single most important concept separating traders who survive from those who blow up their accounts, is risk management, which encompasses the specific rules and techniques you use to control how much capital you are willing to lose on any single trade and across your overall portfolio. The most fundamental risk management tool every beginner must master is the stop-loss order, which is an instruction placed with your broker to automatically exit a trade if the price moves against you to a predetermined level, thereby capping your maximum loss on that trade before it can grow into an account-destroying disaster. Professional risk management practice dictates that a trader should never risk more than 1 to 2% of their total trading account on any single trade, meaning that if you have a $5,000 account, the maximum you should be prepared to lose on a single trade is between $50 and $100, and this rule of position sizing ensures that even a string of consecutive losing trades will not wipe out your account before you have the chance to learn and adjust. Position sizing and stop-loss placement must always be calculated before entering a trade, not after, because once you are in a trade and watching it move against you, The emotional pressure to remove your stop loss and hope for a recovery becomes one of the most dangerous impulses a beginner will face. The eighth step is developing mastery over trading psychology, which research and the testimonies of experienced traders alike consistently identify as the primary reason why the majority of technically competent beginners ultimately fail to become profitable. There are 4 core emotions that are documented to destroy trading accounts with predictable regularity. Fear, which causes traders to exit winning positions too early or to freeze and fail to execute valid trade setups. Greed, which causes traders to hold losing positions too long, hoping for a reversal, or to risk excessive capital chasing unrealistic profits. Hope, which leads to irrational attachment to losing trades with the wishful belief that the market will eventually come back. And regret, which drives the particularly destructive behavior known as revenge trading, where a trader who has just suffered a loss immediately places another aggressive trade trying to win the money back, almost always making the situation significantly worse. The antidote to all 4 of these emotional traps is a written trading plan, which forms the 9th step of this guide and represents the document that every serious trader must create and follow with absolute discipline. A proper trading plan specifies in advance which markets you will trade, what time frames you will use, what specific technical setups or fundamental conditions must be present before you will enter a trade, where your stop loss will be placed, where your profit target will be set, how much capital you will risk per trade, and what conditions must occur for you to exit a trade early. Equally important is maintaining a trading journal, a detailed log of every trade you execute that records the entry price, exit price, the reasoning behind the trade, the result, and critically, your emotional state throughout the trade. Because reviewing your journal regularly is the fastest and most reliable method of identifying the specific mistakes and psychological patterns that are costing you money and preventing improvement. The 10th and final step in this guide is committing to continuous learning and treating trading as a long-term skill-building process rather than a get-rich-quick scheme, because the traders who ultimately achieve consistent profitability are those who study the markets every day, review their trades with ruthless honesty, adapt their strategies as market conditions change, and never stop learning regardless of how many years of experience they accumulate. The world's most successful traders, including figures like Paul Tudor Jones, Ray Dalio, and George Soros, are unanimous in their view that discipline, patience, risk management, and continuous self-improvement matter far more than any single trading strategy or market tip, and that the road to becoming a profitable trader is measured not in days or weeks, but in years of dedicated practice, study, and the hard-earned experience of navigating real markets through both profitable periods and inevitable setbacks. Trading is one of the most intellectually challenging and potentially rewarding financial pursuits available to anyone with internet access and the will to learn, but it demands honesty, humility, and a genuine respect for the risks involved, and every beginner who approaches it with those qualities gives themselves the best possible chance of being among the small percentage who not only survive, but truly thrive.